video, I'm going to talk about how you analyze a company. And I'm going to use G3, G-I-I-I, as an example of how I went about analyzing a company that ultimately made me a 90% profit. So, let's get to it. So, first things first, let's just have a look. Let me just show you. So with G3, this is the company that I bought back in April 07. It was April 17. I bought in over there, and I sold over there. So that's what we're gonna look at today. What led me to do the analysis, how I did the analysis to buy in at that point. Cool. So what I've got here is I've got this file called, which is included as part of the course, part of the downloads, Inv401 valuation of portfolio, and I've included my valuation of the 4 stocks that I held in my portfolio at the time. And we're going to start with G3. So just to give this all some structure, here's just an extract of the valuation, which is what we've done in the previous video. Here's just all the prices of the stocks at that particular point in time, 28th of April, 2017. And then this is what we're going to be filling in along the way as a kind of checklist to do the analysis. So 1, is it at a reasonable price? 2, is the business simple and understandable? 3, does it have an enduring competitive advantage, moat? 4, can you trust management? 5.1, margins on the income statement. 5.2, other comments on the income statement. 6, on the balance sheet, you're looking at the debts and then anything else. On the cash flow statement, we're looking at cash, is the cash from operations similar to income, and then understanding the investments and then the debts. Anyway, so let's get to it. So the first thing is it at a reasonable price? Now that's the whole point of this valuation that we've done. And now for G3 in particular, what we can see is it's, according to this valuation, 100% undervalued. The current price at that point was 23.7. Let's go here, 2370 something, or yes, it was around that point, 23. And according to the valuation, it was worth 48. And curiously enough, I sold it eventually at around close to 48. So there you go. Now the first thing we check is we want to just make sure that this calculation makes sense. So first thing, we just look at these earnings for G3. Okay, rising. Okay, it fell off, and then a big fall off in year 5. Okay, so 32, 34, minus 1, minus 55. So what do we have here? The growth, the average growth is 17% with all of these. What's going on here? Okay, so this is averaging it if it's above 0. So what this formula is saying is, if this is above 0, it's going to give me the average. If it's not, it's going to give me a 0 instead. So we're looking at adjusted growth of 9%, saying it's going to grow 9% a year earnings. That's pretty aggressive. 1.4 to 1.85. That seems like a lot, and that seems like it's worth something that we should adjust. So I'm going to just punch in there, say 5%. If we can manage to grow 5% a year. Okay, and how does that change the calculation now? Okay, so now it's 80% undervalued, with 42, which, you know, it got there. It got to 42. Next thing we want to look at is the PE ratio. So historically, it's got a pretty high PE, 25, 37, 39, wow, 20, 23. So the market expects quite a lot of growth from this company. Yeah, with PEs that high. So generally the market has quite high growth expectations. So average PE of 30, 29.3, 17.5. Already, even that is, for me, that's not really a conservative assumption. That's quite a high PE. So what I would adjust that down to say 15. Just punch in 15 there, just to be a bit more conservative. And where do we land up with? Okay, 59% undervalued, being a little bit more conservative. And then just have a look at what average earnings. It's saying 1.86. They haven't had losing years. And in the prior 3 years, they did manage to do 1.8, 2.4, 2.6. So 1.8 is not totally unrealistic. That's 2.26, just the average of those three. 1.8 is not totally ridiculous. I think we could go with that. So just adjusting these assumptions down, being a little bit more conservative, we get a 60% undervalued. Now, where does this thing end up? Let's have a look. Sorry, so to evaluation of 37.7, which is there. So now, a part of why you might ask, okay, so it rose to 37. Why didn't I sell it there? Part of the way the market works is it overshoots in both directions. It undervalues something, the market goes crazy, and then when it starts rising, the market goes crazy on the upside too. And that's basically part of the reason why I held it. Once it got to this point, I was anticipating the market going crazy and the price shooting up as it possibly overshoots on the upside. So maybe it is only worth about 37. But I held it and waited for it to shoot on the upside. So there we go. In terms of valuation, I'm not going to write the long story now, but it's just to show you. So this is G3. That's the actual name. We can just check that now. But is that at a reasonable price? So I would say, we're adjust growth to 5%. Adjust growth. Can spell growth. Try that again. Growth to 5%. And what else did we do? Adjust PE to 15. Adjust PE to 15, and we land up with 60% undervalued. Adjust growth to 5%. Adjust PE to 15, and it's 60% undervalued. So after having a look at the valuation calculation, we're still sitting there going, yeah, there's an opportunity here. It does still seem undervalued. So let's carry on with the analysis. Often you can do this and you can look at the valuation and go, these numbers are crazy, it doesn't make sense. And you adjust some of these assumptions and you find that it's no longer undervalued. My line, as I've said in previous videos, is 30%. I'm looking for something that's at least 30% undervalued. So the market price is trading at least 30% below its actual value. I want a margin of safety. So next thing is we want to understand the business. So is it simple and understandable? So you want to go to a website called www.sec.gov. Okay, so let's just go there. www.sec.gov. And there we go. Look at this nice sort of family. Anyway, now we want to click on company filings. So you go there. Right, now in this fast search bar, you type in GIII, G3, search, hey. And then in filing type, we want to type, here we go, it's got 10K, so 10K. Okay, I brought nothing back, 10-K. Cool. So now I would have been looking at this at the 2017 report. Okay. So let's just, let's have a look at that. So click on documents and then form 10K. And bang, this is what you look at to analyze the company. This is their filing that they submit to the government as a listed company. So just Control-C, copy that. G3 Apparel Group. So we want to match. There we go. So now to understand the business, if you go back to this web page, let's just go to the. Now the 10K, to read it from one beginning to end is incredibly boring, and I'll be honest, it's not something that I do. I focus on specific things. So I haven't seen an index in this particular one, but you look at, there's business and then risk factors. So we're going to quickly just look at this business thing now, and we're going to look at risk factors, which would be further down. So let's just scroll down. Retail operations. Blah, blah, blah. Blah, blah. There we go. Risk factors. So that's what we really care about. So what do they say about the business? Business. Very exciting. Designs and manufactures extensive range of apparel, including outwear, dresses, sportswear, swimwear, as well as women's handbags, footwear, leather goods, blah blah. We sell our products under our own proprietary brands, which include DKNY, Donna Karan, GH Bash, blah 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 blah. We sell products under exclusive portfolio of well-known licensed brands: Calvin Klein, Tommy Hilfiger, Karl Lagerfeld, Levi's, Dockers, Kenneth Cole, Guess, and it goes on and on and on. And this is where I thought, ooh, this is interesting. These brands that they sell are quite popular brands, in my understanding. You might disagree. You might go, I'll never wear Calvin Klein, but hey. Okay, so our products are sold through a cross-section of leading retailers. Blah, blah, blah. We distribute other products through our own retail stores. Okay. Outlet stores. Operate 119, blah, 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 blah. So they got all these brands that they license. And then they do some of their own retail. But predominantly it's they license these brands. Okay, recent acquisitions. Okay, they bought the Donna Karan brand. You get the idea. I mean, you can read it in detail. But the thing that, okay, here, competitive strengths. We believe our broad portfolio of high-profile brands combined with our extensive distribution relationships position us for growth. We intend to capitalize on the following competitive strengths in order to expand our position as an all-season diversified apparel company. So there you go. If you want to understand the business, they are an all-season diversified apparel company. Okay, this is if in doing the analysis that I'm going to sort of sell this completed spreadsheet, I'll do a sort of more detailed story, but just for the purpose of this spreadsheet, you can see now, okay, all season diversified apparel company. Let's just go back to the 10K. Just, yeah. Okay. Broad portfolio brand recognition. Blah, blah. Okay, so here's just a list of all the brands. There's some very, very well-known brands. I'm not going to read all this in detail. You can go through it yourself, and you can decide if I was stupid in buying the stock. But that's what you look at. Wholesale operations, development design, wholesale operations, blah blah. So risk factors is the next thing that's very important to look at. Just see what they have to say. Control F. Risk fact. There we go.